Here's what's coming up on today's show.
When you work with an advisor that has a good grip on what he's doing or what she's doing, you can navigate these markets. Doesn't guarantee you're going to have a certain return, doesn't guarantee you're not going to have some losses, but you should never be in a position where you have catastrophic losses.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Iammarino, and I am joined by my esteemed co-host and great friend on the East Coast, Mr. Tom O'Connell. Tommy, how you doing?
I'm doing great, John. Good to hear and see you once again on our 99th podcast.
The 99th, and we are having a very special guest on this podcast. 99 podcasts. So couple years running, and a little quick shout out to two people. First, we had my son's 12th birthday, so happy birthday, Jake. We had that this weekend, and a somber but absolutely powerful tribute to Tom and I's good friend, one of the original three mentors, and a guy that has touched tens of thousands of lives through the advisors that he has helped. He was supposed to be a guest on our show the day of the tragic stroke that he had, but Mr. David Gaylor passed this last week, and it's with tremendous sorrow, but respect that Tommy and I dedicate this episode of the podcast to David. And Tommy, you got anything to say?
Well, he was a great friend to us, a great mentor. And as you mentioned, through the advisors that he worked with and his book, Income Allocation, he has touched literally thousands and thousands and thousands of lives, probably saved thousands and thousands of retirement plans for clients, helped people retire with ease and happiness and guarantees. And he's a legend in this business, and in our hearts that will be sorely missed.
Yep. So David, this one's for you. And speaking of mentors, this is the last podcast of the year. We're in the typical season of the Santa run, and we don't know what 2025 has in store for us. And so on this very special episode, the 99th podcast of the Retire Happy podcast, I want to introduce our next guest, the CEO and co-founder of Catalyst Wealth Coaching and six-figure trader. He has a six-figure trader podcast on Spotify and Apple. He has a website, which is the number-figuretrader.com. Joe Casey is his name. He is a mentor of mine. I had the opportunity to be invited into his very tight-knit and exclusive retirement or investment planning, I should say, mastermind group this last July. And he is an unbelievable wealth of knowledge when it comes to the markets. He has done extremely well for himself, for the advisors that he's coached, and for, just kind of like we mentioned with David, he is impacting hundreds of clients' lives through the knowledge that he gives the advisors in his Advisor's Edge mastermind group. He's been to MIT to study blockchain and crypto investing, and he's also studied and has dedicated a great many years to learning how the institutions, the big money, invest. So, folks, this is one of the best investment minds out there, Mr. Joe Casey.
And today today's guest, the CEO of Catalyst Wealth Coaching. It's Joe Casey.
Hello, John. Thank you for that great introduction. And I am honored to be your 99th guest, or at least be on your 99th show. And so the number 9 represents growth. So congratulations. That's awesome.
And I love the growth, because that's what you're helping my clients do, and a lot of other stuff through your program. So welcome.
Nice. Thank you. Glad to be here today. Look forward to a great show.
Yeah. So, for a lot of listeners and clients, Joe's program, he puts a lot of time, and it's a very, he's got, every morning I'm on the webinar listening to his webinars, his whole library of videos that he has. And then he also puts together we have about 2+ hours of live conversations and recorded videos on the markets every weekend. And having my investment advisor license, my securities license for over 12 years, my knowledge of the markets has gone up tenfold since working with Joe. And it's been an unbelievable journey. So with that, let's start off with a pretty wide casting question, Joe. What's the problems or the challenges that today's investor, including advisors, have with the markets? And it's a pretty general question, but what are some of the biggest issues you see with today's investors?
That's a really, really good question, because it's really you would think right off the bat, well, an average kind of lay person, maybe they don't know what they're doing, and maybe they just haven't had time to figure it out. Well, that's true, but you see this very common thing actually within financial advisors. They just don't know what to do in certain markets. Obviously they know how to, invest a portfolio, but that's kind of like throwing spaghetti up against the wall and, see how much will stick on the wall. And unfortunately, a lot of advisors take that approach. And, it works. It works for a period of time until it doesn't work. And we have a major market correction. And then they basically give back what they pretty much had made for their clients. Usually the client ends up with 3 to 6%, which, sounds okay. But time you figure in taxes, you figure in these different costs, well, you really didn't make nothing. And so I think the big problem that people face today is the markets are really geared towards the big institutions. And you just got to learn how to navigate that terrain. And a lot of people don't understand how to do that. And the institutions are not actually showing you. They're hoping to keep people ignorant. They're hoping to keep advisors ignorant. Because, when they go to sell something, and I'm sorry for being so bold, but when they go to sell something, they've got to have buyers, because at the end of the day, the market's a zero-sum game. If you're selling, somebody's got to be on the other side buying. And if people's not buying, then that's a problem if the institutions are selling. So they control the narrative. They actually... they do things in the market that creates manipulation, and it's very difficult for the average investor, the average advisor, to really stay on the right side of the market. You've got to you've just got to become aware of what's going on so that you can actually start looking for the right path to follow.
What might be a couple of typical examples of how the market is skewed towards the big investment houses versus the mom and dad investor?
Well, that's a big question. It's a good one, but that's a big one. But you've got companies, like BlackRock, Fidelity, Schwab, any number of these big brokerage firms, many of which you've never even heard of, they're looking to make money, and they're looking just for a few cents here and there, and all they've got to do is have the market just move a little bit to make a lot. And so when you start thinking about some examples, well, I just had a trade in gold, for example. And what'll happen is an everyday retail trader, we'll say, for example, starts looking at gold or maybe looking at Bitcoin, because Bitcoin's like just going just crazy right now. And by the time that most people hear of something like, oh, well, I got to get in that, well, the move's already happened. And just out of FOMO, you're just like, okay, well, I got to get in this thing. Well, by the time that you've basically got into it, you've got in too late. And you're buying when they're selling and the move's over. And so it's number one, it's just being informed. It's having the right type of software, the right type of indicators, all of those things that you need on in your basic toolbox that you just don't have. And take for instance this Bitcoin move. Well, Bitcoin has shot up from like 50, 60,000. It's over 100,000. I think this morning it was 107, hitting all-time highs. And I've studied Bitcoin for years, and about the time that the main street is piling into it, that's when the institutions will start selling, and everybody will be hating Bitcoin come February, March, because it's going straight down and people are losing money.
So that's kind of like the psychology, unfortunately, of the everyday advisor. We were just talking about this before we started the recording. Unfortunately, it seems like mom and dad or the average Joe, they're always buying at the high and selling at the low. It's more of an emotional transaction for them, as opposed to, like you're saying, an informed transaction.
That's exactly right. And it's so easy to really miss what's happening in the market and kind of get sucked in emotionally. You see, the stock market has its own language, and this is what we teach guys when they come into our program: is you've got a framework, it's a structure, and you've got to learn this language, or you're going to get run completely over. And so, the average retailer, they just see it going up. They get excited. We're all human. We see something like, yeah, man, that's great. Well, you think about it. Institutions have paid psychologists for years and years and have, full boards full of psychologists analyzing prices, analyzing the masses. And in essence, when you're looking at the market, you're looking at mass psychology on full display. And when you see things move, you're seeing a massive amount of people make decisions. And often these institutions, there's no pretty word to use here. They just fake people out. And like I said, by the time that a lot of your retailers pull the trigger, they've got so emotional. They're married to the idea. They jump right in. They invest. It goes great for a few days, and next thing you know, just right down it goes. And it's just not good when that happens. Then you've got to stay, right? You've got to hold it till you get your money back to where it was. And so it just becomes this ugly process.
And Joe, you had mentioned how, they hear things and then they go to make the move, and it's already too late. And I think the three common areas, at least that, I've heard in my office, I know Tommy and I have talked about this, is people will reference, or they'll email or call us like, hey, I heard this on Fox Business. I heard this on CNBC. Warren Buffett is now all in cash. Or I've got a newsletter from a guy that I get every month. And, I've had some success with this newsletter and following it. But can you make mention to how, some of that manipulation happens? Like, we've seen it that, yes, by the time the news gets out that Warren Buffett is already in cash, well, that play, we saw that weeks ago. Can you talk about the delay and how that's also used for, potentially used for manipulation and really the loss of value because of the delay?
Yeah, absolutely. And, here's the thing is that Warren Buffett, he tries to be very, very discreet about how he sells, how he buys, and he doesn't really say one way or the other what he's doing. You find out by watching what he actually does versus what he says. And what happens is give you an example, like when Russia invaded Ukraine. Well, all of a sudden, I had people that don't invest into the market. They called me on the phone and said, Joe, how can I buy a wheat, something to do with wheat? How can I buy a wheat ETF? Or I was like, well, why do you want to buy something in wheat? And they said, well, Russia's invading Ukraine and they produce a lot of wheat product. I was like, oh, okay. And so what happened is as soon as Russia, literally the day of, you can go look at wheat futures just went crazy, just literally straight off the charts. People were thinking, man, bread's going to be $30 a loaf, and you better get you a whole bunch, put some in the freezer, and so the wheat goes straight up. People start FOMOing in like crazy, and then institutions come in, and obviously we have an actual trade set up right at the top of wheat. It's like March, April of that year, that spring, and you can see where the price was manipulated, and wheat literally fell off the charts. It was crazy. Whoever invested, they lost a ton of money. And so it's just this hype gets built up, and that's one thing that really drives the crypto markets as well. Just a lot of things get hyped up. People climb aboard. Next thing you know, it's going the opposite direction.
Yeah, these markets aren't as simple as 10, 15, 20 years ago when you just bought a basket of 5-star Morningstar mutual funds into different sectors, right? I mean, now
Right.
with literally thousands of ETFs and thousands of mutual funds, they're fading, but then thousands of individual issues of stocks and all the other kinds of derivatives and everything else that's being sold these days. It's got to be impossible for again, the mom and dad everyday investor just to be able to get a handle on what's going on.
Absolutely. You've got to put some real work into it. And if you're fortunate, you can find a financial advisor that actually knows what they're doing. That's going to be your best bet. Because if you're really going to pursue buying and selling in the market to really do it yourself, it's going to be tough. You're going to have a system. You're going to have a proven system, not just any system. There seems to be a lot of systems online for sale, but you don't want to buy them, I promise. And if you can find a financial advisor that can keep you on the right side of the market, that's going to be the number one real key, is staying on the right side of the market. Because like you said, you've got all these different types of financial instruments, buying and selling, and a lot's going on. And it's almost too much for any one person to really wrap their mind around. And so there's some key things that you can look at that will help you keep your monies on the right side of the market. And that's what we teach in our program that John's in, and many other advisors. And the whole goal there is not to time the market, not to beat the market. The whole goal is simply to stay on the right side of it. And by staying on the right side of it, you boost your returns. That often does beat the average return of like the S&P, but really staying on the right side. And what I mean by that is during the bullish markets, you're in a kind of bullish mode. You're partaking of those growth portfolios. When the trend comes to the end and is no longer your friend, well, that's time to sell and move to fixed income. And see, that's where people really get it wrong. They understand the concept, buy low, sell high, but they never sell. They just like, I got to stay. I got to get more, got to get more, got to get more. And what happens is the trend changes. It switches hands. It goes from the bears to, goes from the bulls to the bears. and they turn around and give back 60, 70% of their gains. And if you are really watching things, the whole goal is to stay on the right side. So when that handoff takes place, when that trend shifts, you want to shift with it. And the average market cycle is between 18 to 24 months from trough to peak. So somewhere in that area, you're going to see that trend handoff, and that's when you typically want to make that transition. You're trying to not be greedy, because greediness, you're going to end up a loser. What you're trying to do is you're trying to harness what's there, and when you've got profits, you use good risk management, because like we've said many, many times, anybody, when the markets are going up, anybody can throw a dart and hit a stock or two that's going to do well. The real test comes is when the market goes through a bearish cycle. Everybody knows who knows what they're doing at that point, because good risk management is how you actually keep your profits. Because if you just throw the money in, just let it ride, well, you're going to turn around and you're going to give about 70% of it back. And that's just the ebb and flow of the way the market moves.
And that's where your psychology comes in, because you've lost that 60 or 70, you're going to hold on for dear life, waiting for it to come back, right?
Yeah.
And that's where people lose. The one thing I always say to people is the pigs that go to market get slaughtered. So you have to have your number in mind, whether it's a percentage, a dollar amount, whatever it is. Basically, like what you're saying, Joe, is there has to be a point where you're ready to walk away.
That's
And
right.
when you see the audience sees the map that you have, you're never getting in at the perfect bottom of the trough, and you're never getting out at the perfect peak of
No.
the mountaintop. You're capturing the bulk of that swing, and then you're just saying, I'm happy with my return and I'm walking away.
That's right. And when people enroll in our program, the ultimate thing that I really strive to teach people is you don't trade the market, you trade your system. That's what you're trading. And because if what if you get in a position, it goes up, you sell, and then it goes up more? Well, so what? You got what you needed. You trade your system. The market could do anything at any time. It could go completely crazy. And you've got to have a set of fundamental and technical rules that you put in place, that you let that system work for you, is what your ultimate goal is.
Tomorrow, there's always another deal.
That's right. That's exactly right. Always, I heard one old guy say it this way, opportunities like buses, there's always another one coming.
That's it.
Yep.
And Joe, I think in the last 6 months, the biggest thing that I've gotten out of your program, that as an advisor, it was always, we're always looking at the downside, especially retirement planners. Tommy and I, we have our accreditations for retirement planning. We're always worried about the losses, because we understand the psychology and the impact of the losses on a retirement portfolio. However, for me personally, the confidence that I have now going forward, and the understanding of, listen, the best time to be invested or not invested, but to have that clarity, is in a true up and down market. And the worst time to really try to make decisions is in that housing price range, or that chop zone that we're in right now. And I love how every week you're reiterating to advisors of, the markets are at all-time highs, but we're not in a very good market to just take a new client and put you in the markets. Like, now's the time to be, conservative with that new client, and to actually have, as you say, 40 to 50% of your profits pulled off. Because where we're at now, the markets can whipsaw on us very quickly, and it can be very detrimental, especially to a new retiree.
Yeah. And that can be devastating. I mean, I remember just listening to people that had lost a significant part of their retirement back in the early 2000 crash and then 2008. It's just, it can really, really be very detrimental to you to lose money. And I know we're kind of spoiled because the markets have been going up, up, and up, and really just a brief COVID flash crash and a little bit of a downturn in 22, but we've not had a 2008 or early 2000. But, at some point, we're going to have a significant correction. You can't have what you've had over the last 5 years and not have one. And risk management is going to be what separates, and good advisors from great advisors, and from winners and losers. To get right down to the brass tacks of it, because a lot of people just they kind of get lulled into this sense of like, well, the market's just going to go up, go up, and go up. Well, that's fine for somebody that's 30 years old, but a retiree that's taking money at 65 years old lose 50% of their portfolio. Well, they may never come back to being whole, as you well know. So you've got to really do that income planning and all that stuff right up front. But even the money that's in the market that's there, you still have to watch that money, because you can really boost the gains by just learning to navigate the markets and avoid all those losses. There should be no reason why a client or an advisor should take massive losses for a client. But there's a lot of them that do, because they simply just don't know what they're doing.
The way John and I and many of the, especially Brookstone advisors, the way we align our portfolios, I think to start really are preservation first, growth second, right? Because we are retirement planners for the most part. And like you said, a retiree taking a loss, it could be devastating. It could be even worse if they're taking money from their portfolio at the same time that they're taking that loss. And, that's when people start standing on window ledges. And that's what we're continually trying to avoid.
And it's such an uphill battle, because you've got the news media, you've got all kinds of false assumptions, you've got all kinds of it's just not correct information. And, you take some guy that works at, here we got Ford plants in Louisville, a guy that works at Ford. Well, he didn't study the stock market or anything like that, as his career. And so he's just picking up the news here, picking up the news there. And he's just trying to make a great decision for himself. And it's just like you get lost in this whole sea of, okay, what am I supposed to do? And ultimately you have to either decide you're going to dedicate years to studying the market so you can figure out what to do, or you got to trust a financial advisor. And at 65 years old, where you've already put years in as a career, maybe at Ford or somewhere like that, I think it's a little late to start becoming a financial advisor at that point. It's not to say that you can't, obviously. So it really does come down to finding a financial advisor. I used to tell my clients all the time, especially prospective clients, that the greatest decision of your retirement is not going to be when you elect Social Security or where you're going to draw money from. It's going to be flat out what financial advisor you hire. That's going to be the biggest and most important decision you're going to make, period. And it still rings true today. Having the opportunity and privilege to coach, hundreds of financial advisors, being on this side of the advisory world is much different than when I was on that side, being an advisor to clients. And I tell you, there's a lot of guys out there. They mean well. They want to do good. They truly want to help people, but there's just a lot of misinformation, a lot of misinformed people. And you guys are informed. That's the great thing. You guys pursue the wisdom and you put in the work necessary, because the market isn't some mysterious thing that's just nobody can understand. Kind of like the Bible. You mentioned the Bible. Some people are like, well, you can't understand the Bible. And well, if you start reading it, you can understand some things. And the stock market, when you work with an advisor that has a good grip on what he's doing or what she's doing, you can navigate these markets. Doesn't guarantee you're going to have a certain return, doesn't guarantee you're not going to have some losses, but you should never be in a position where you have catastrophic losses.
Joe, you mentioned trying to learn this and spend years. On your Thursday calls with the group, you have some very seasoned veterans and a couple of guys that have been with you, from the get-go on this. And you could tell those guys from the guys like myself. But I have spent literally probably about 5 hours plus a week for the last 5 months going through your programs, and the amount of knowledge that you're sharing and the amount of knowledge just on this topic, it's overwhelming, and it's, again, 12-year securities vet. And, I know you have some guys that are just, 2+ decades, that this is still a lot of overwhelming new knowledge for us, because we've been kind of just, hey, guided into, hey, follow these models, use these. And, this group is really searching for the better way. But, if you're a do-it-yourselfer, you better buckle in, because you've got a lot of information,
Right.
a lot of information, and very difficult to grasp information. I mean, luckily for me, we got a guy like you that can just simplify a lot of stuff. But, this is definitely an undertaking, a wealth of knowledge.
Yeah. Well, if it was super easy, everybody would do it. And it's one of the, investing in the market, there's a variety of different strategies, obviously. You can keep it super simple, or you can get very complex, as you well know. And so if you are a retiree and you're looking just to enjoy your retirement, obviously you want to find a guy or gal that really knows what she's doing or he's doing, and let them do their job. You just don't want to make the fatal mistake of hiring somebody that just throws the money in the market, doesn't really know what they're doing, and they find out when the market's crashing when you find out the market's crashing. Not a good way to go about it. And it really does come down to when you are an advisor, it's just like anything else. You've got to put your work in order to really stay sharp and to really be able to, choose the right directions. Because here's the thing, the economy, the markets, all of this stuff's constantly shifting, constantly, subtly changing right before us. And you just, guys and gals get lazy. And like you've said several times, you've spent hours weekly studying. Well, you're not studying just because you don't have nothing to do. You're studying because you want to do a fantastic job for your clients. You don't want to be surprised. You don't want them to be surprised. And so by putting yourself in a position to where you're being a student of the markets, you're not going to be surprised. You're going to be able to see those turns and shifts and be able to take proactive actions. And that's ultimately if I was a retiree and I was coming to you to manage my retirement, that's ultimately what I'd want you to do. Just make sure I'm in the best place. And not just this day we're sitting here talking, ongoing. And I think that's what you do, John. I think you've proven that. Just number one, being in our program tells me that, you really want to do good for your clients. And that's the kind of financial advisor you really want, period. Someone that's going to, really pay their dues, that's going to study, and that's going to do the job.
Yeah.
And I think the one word that sums all that up is cares, right? And I've known John long enough to know that he takes all of this to heart, right? And we all, we talk on the phone all the time. We're texting, emailing each other all the time, and we're always back and forth trying to figure out, hey, what can we do? How do we make it better? How do we protect? So on and so forth. And again, it just sums up, he cares, and people should take a lot of comfort in that.
I don't want to just say, I appreciate you both saying it, but everyone on this podcast cares. I mean, Joe you could have easily taken this information and just did your day trading, your swing trading, because you make a good income doing it. You didn't have to share this wealth, and you don't have to, you sold your practice and retire. You could be playing around with this money, but you're sharing
Right.
knowledge. And
Right.
Tom, I mean, more than half our calls are me coming to you for advice, and the amount of mastermind networks that you're in to get better. And that's, 99th episode, the conversation that goes back to when you and I were camping together and having a drink talking about the podcast is, hey, you straight up said, let's join forces and take this to another level. And let's bring in the wealth of knowledge out here for the listeners.
Right.
So I think that's across the board for all three of us. I mean, that's what it all starts with is absolutely pouring our heart and souls and our passion into making other people's lives better.
Yeah. 100%. And that ultimately is why I launched the Catalyst Wealth Coaching. After I retired, I started getting people asking questions. Some of my peers, some of my associates saying, "Joe, help me with this and help me with that." And then I just found myself kind of saying, "Okay, I'm starting to get busy. What do I do? Do I actually start a business and start helping, or do I just stop altogether?" And we finally did launch in 2022, but probably the biggest reason that we launched our business to do what we're doing is that I discovered in my career that at the end of the day, if I was working with third party managers, at the end of the day, the third party managers are doing their job, investing, rebalancing portfolios. They've got the portfolios there for me to use. Well, what I ultimately realized in my career is that me, the financial advisor, I had to be the person that pulled the trigger on Mr. and Mrs. Jones' investment portfolio. The third party manager was only going to invest it if I said, yes, go ahead and do it. And so I realized that there's nobody teaching financial advisors how to actually do that. And so it's almost like they're blindly thinking that the third party manager is just going to take care of everything. And it's not the third party manager's job. Their job is to rebalance the portfolio, put positions in. It's not to navigate the highs and lows of the market. And for a younger person, it doesn't matter. You just need to put money in the market every month, grow that money over, 30, 40 years. But a retiree, you've got to navigate. And it's your job as an advisor to make that call. Well, I realized, number one, that not very many advisors recognize that until they get whipsawed themselves, where their clients lose a bunch of money. They look at their third party manager and the third party says, hey, you know what? It'll come back at, they say that's just the way it is. And the advisor then realizes like, oh, wow, I have to bear this burden of making this call. And so that's why we put our program together so that, number one, they would have information that they could learn to do this job successfully. Number two, also for a way for them to make extra money by actually investing their money in the market. So I'll tell you right now, it's one of those things that as an advisor, you have to know that you just can't turn a blind eye to managing assets and just assume a third party manager's got your client's best interest. They've got the interest there, but they're not really in the position to do that job in terms of navigating the market. I know that sounds weird, but that's the truth. You have to do it as an advisor. And that's why advisors enroll in our program, because they want to be empowered so that they can actually take a look at the market. They can see where things are going. They can read that market language like we talked about in the very beginning. And by understanding the language, they know exactly what to do.
Yeah, and the key word there is empower, because
Yeah.
I feel more empowered than I ever have in any market situation. And I've talked with Derek over at Brooks. I mean, you have got a big fan in Brookstone, and how you're just complementing what they've already set up. So, we've been going a while here, and I want to give the listeners one great piece of information. And I'm going to ask you to put on your Karnak hat. All right. No one has a crystal ball, but I would like to give you props based on your analysis. You said that the market would hit 6,000, the S&P 500, and it did. Where do you see the markets going in 2025? I know overall we're bullish for long term,
Yeah.
but 2025, what says Joe Casey?
Well, I will say this is that bull markets die hard, and they always last longer than what people think they should last. And so it's just that's the way it is. And so with a new president coming in, a lot of optimism. We're hoping for the best, right? We're hoping everything works great, everything goes great, but you just never know how things are going to really unfold. What I see is I see us getting through the holiday season, kind of getting into first quarter. And I think by the end of January, if the market is kind of unchanged and it's just kind of grinding up just a little bit, going sideways, that's probably not going to be a good sign. And so I'm going to be expecting a significant pullback as we get into like late February, going into March, April. And so I see the market correcting. I do. I see it correcting. I see it pulling back. And at some point, whether it's in March, whether it's in May, or whether it's in August, the markets, I really believe, are going to pull back because right now we are 25 months in since the trough of 22 market. And so we're past that average. Being past that average, that every month it goes by, that's getting things really, really stretched out. So I would expect a nice pullback. And so that's my take, John. That's what I see.
Yeah. And, to your credit, again, past performance is never an indication of future, but you were pretty spot on in February of 2020. You were pretty spot on in December of 2021. And, in the training, we've seen the cycle tops hit these last couple of months. And we also understand that there's a price divergence of momentum dropping and price moving up. And as you've told us and you've taught us, that has been a key indicator of the last four market corrections. And in our last call, you're saying you wouldn't be surprised if the S&P 500 dropped below 5,000.
Yeah. Yeah, absolutely. If you look at the way things are moving right now, the market's barely grinding up, and that's just kind of what you see during the Santa rallies. Very low volume, and the only wild card in the whole bunch is the new administration coming in to the market. It's hard to say or to the economy. It's hard to say what's going to actually come out of that. It's going to be very interesting, number one, to see what the Fed meeting is here on the 18th. So I don't know if this will be out before then. That's a couple days away. That's going to be a big, big thing right there, where they're going to set kind of the expectations for next year. So that could have a dramatic impact right out the gate into 2025. So with that wild card of the new administration, here's what I will tell you. I'm not going to do anything until I see the chart tell me what to do, because I trust the chart. When I look at the chart never lies to me, and it doesn't fake me out. It doesn't pump me up. It tells me the truth. And so when I see that market shift, that you'll know it then, because then that's when we'll start moving into more of that defense position. But right now, the way things are looking, I would expect a downturn at either late first quarter going into second quarter.
Awesome. Awesome. Well, Tommy, you got any questions while we got the amazing Joe on?
You know what? I think I had enough drinking out of that fire hose.
Yeah. And, like always, Tommy and I, over the last couple of years, we've tried to bring you the best of breed. To be asked on our show is not taken with a light grain of salt. Tommy and I have a lot of conversations about trying to pull the best of the best to share that knowledge and to have the impact that people like David and Joe have had, on this world. So, Joe, thank you for spending your time. And we hope that this episode was a powerful 99th and that, our clients' portfolios grow, as the number 9 says, and our listeners' portfolios grow. And, as we mentioned before, we, encourage everybody to go on Spotify, Apple, listen to the Six Figure Trader podcast. And Joe, if you're an advisor and you're listening to this show, I strongly advise Joe's program. And if you're a do-yourselfer and you're looking to really dig deep and dive into the world of investing, I recommend his program. So, Joe, in closing, where can people find you? Both our competition, the advisors, because we wanna make an impact worldwide, and the do-it-yourselfer.
Yes, absolutely. CatalystWealthCoaching.com. You could easily Google that up. If you want to get right to it, you can put in Six Figure Trader. That's 6-figuretrader.com. And just go to Spotify, go to Apple, pull up the podcast, jump on it and see how you feel. And then, hey, shoot us an email, give us a call. We'll be happy to talk with you to see if our program's a good fit. We're very picky on who we let in our program because we want it to be a good fit for each individual. We want it to align with their goals and where they're going. And so, give us a call.
So, folks, that wraps it up for the 99th episode here. As we head into 2025, I just want to say on behalf of Tommy that you have a Merry Christmas, a Happy Hanukkah, a safe and happy and prosperous New Year. We hope Santa brings you great gifts, and we hope the Santa Rally continues for 2024. And we are going to be excited because we have one of our favorite guests always every year that we start the new year off. And there's really no better person to have on our 100th episode beginning 2025 off with a person who has impacted Tommy and I's lives. None other than, again, the CEO, the president and founder of Brookstone Capital Management, Dean Zayed. So we can't wait for the new year. Until then, folks, we hope you have a wonderful rest of 2024 and retire happy. God bless.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-758-9889. That's 858-758-9889. Or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623. And online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description of today's show for all that contact information. Don't forget to subscribe and follow the podcast on your favorite apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Amarino, Thomas O'Connell, and guests on this show are their own, and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk, and unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives, and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.